cord to this computer. Hi, Jesse. Are you listening to me now? Yeah, okay. Not sure if he's hearing me, but yeah, let's start, okay? This is the second part of the Trading Basics course. And today we're gonna talk all about how to get rich, okay? We're gonna get rich quick. So I wanna ask Eddie, if you can answer, what do you think is the easiest way to grow an account? Like a trading
Put money in it.
No, except like, yeah, but to grow it, like to make money on an account.
I don't know. When I figure that out, I'll tell you, because everything I've tried so far is able to do that.
Look, man, the easiest way is just bet your entire account on 125x leverage, and it just goes up by 1%, and you now have doubled, right? So if you have $100 and do this like maybe 10 times, you'll be the next billionaire. Okay, it's really easy, right? You agree? It's just like 10 trades and you're suddenly a billionaire. But when you say that out loud, it kind of looks silly, right? And why is that? Well, this is ridiculous. Okay, it is intuitively stupid, but like you don't even need to think that much to realize that if you did that, you would be broke in no time. So what can you do about that? This is the main idea behind the risk management concept, okay? It prevents you from losing your entire account or losing a sum that you cannot recover, okay? This was a more extreme example, okay? But like responsible risk management can be really hard, especially if you don't have a good idea of how much you need to earn to break even if you lose and stuff like that, okay? So first things first, one thing that I think is very important is that when we make a lot of money, it's really, really easy to become overconfident in our skills and start risking too much, right? You know, when we first start trading, if we have like some education on it first, we may only get like 10 bucks on each trade or something like that. And then we start getting confident and say, well, I'm the next big trader. I'm going to be the next rich guy. And now I'm going to bet like 20%, 70% of my account in a single trade. Okay. Well, now, this is an image that I grabbed from the Wall Street Bets like subreddit. And this is like the account balance of this guy on Robinhood. Okay. So you can see here, like a very steady gaining. Okay. So here, the guy was like responsible, right? Taking managed risk, reducing his exposure to total risk. And here, he tells us he discovers Wall Street Bets, okay? And now you can see his account balance is way more volatile, okay? It's not increasing slowly anymore. It's going up and down and up and down and up and down. And what happens is you get more exposure to volatility because, well, I'm the next big trader. I'm going to be the next rich guy. Just keep on trading like I do, and I'm going to be rich, right? But it's not like that. You start risking too much and then you start losing too much. So this guy, he had like almost 50K at one point, and then he lost down to 22K in like one day. Okay, so this is kind of a cautionary tale. And if you search, you can find this post. I think the name of the post is like, guess what time I found out about Wall Street Bets, something like that. So yeah, also one thing that I find can be really useful to, you know, just don't do this is to look at liquidations in any given day. So if we go to buybt.com, I've showed this site before, you can just see. So let it just load for a bit. In the past 24 hours, 53,000 traders were liquidated, and the largest single liquidation was $2 million. Okay, so someone, because they traded irresponsibly, they just lost $2 million that they cannot get back. So for example, if they bought on spot, for example, Ethereum, which is the case right here, maybe Ethereum goes up again and they recover their money, right? But here they just lost $2 million, right? And this is why it's important to manage your risk. Okay, you can lose the money at any time in your entire account, and the more you lose, the harder it is to break even. Okay, so this is like a really easy Desmos graphing calculator like example right here. Just let it load. And I'm going to collapse right here. So the more you lose, the harder it is for you to gain back your amount. Okay, so if you lose nothing, then you have to earn nothing, right? But if you lose like 50%, now you have to do a 2x on your account. If you lose like 66%, now you have to do a 3x, and this increases very, very fast. You can see it, right? So if you lose like 90% of your account, now suddenly you have to do a 10x. And well, what was the last time that you did a 10x on a single trade, let alone like your entire account? Okay, this is very hard. It might not look like so, but I mean, it's really hard to do a 2x on an account. So losing 50%, you might take years to recover. Okay, so manage risk responsibly. This is the idea that I'm trying to give you guys. So there's also a hidden danger of not managing risk. So even if you have a high win rate, like say 65%, and most people say that technical analysis only gets like 70% of the time right. Okay, so 60%, 65% is like a good win rate. I would say you're like on the top end of traders, right? Like with time, the chance that you encounter a losing streak can become really relevant. Okay, so for example, over 10 trades, the chance of you losing like the 5 trades in a row would be only 2%. And we're going to go over the specific formula for the percentage chance right here on the future, because it's really like hard to kind of understand where it comes from. And I don't want to just give you the numbers so you can do it. I want to give you guys like the understanding of how it works. Okay, so over 10 trades, the probability of losing 5 trades in a row is just like 2%. Okay, that's low, right? It's probably not going to happen. Over 100 trades, that's 29% approximately. And over 500 trades, it's over 80%. So if you're risking like 20% of your account on each trade, you'd be very likely wiped out given enough time, right? This is the main idea here. Now, this is not accounting for like when you lose 20% the first time, you are now the second time you're losing 20% of the 80%. So you're actually losing 16% of the initial amount the second time, and so on. This is considering that you're risking like the same fixed 20% each time. Okay. All right. Next, well, how do we do it properly then? Well, as almost all things in life, it kind of depends, right? So first, how disciplined are you? So if you're very disciplined, then you might be able to do stop losses and take profits manually. You might be looking at the chart and you'll say, well, this is a good zone to take profit. And well, from here, it might go down more, so I can just get the losses. But if you're not very disciplined, and like 99% of people are not, you're better off like setting things fixed before you trade. Okay, how often are you trading? So if you're only taking like 1 trade a year, then well, it makes no sense to only risk 1% of your account per trade, right? Because well, you're only trading 1 time per year, so you're gonna earn no money. It will take like millions of years for you to make money. What's the size of your account also? Because some exchanges, they have like lower limits on the amount you need to buy or sell. So if you want to buy less than $10, they would not let you. So you might have to you might need to use higher position sizes. Okay, there are a few rules that might help you, but it is up to you to design your system. And this requires a lot of thinking and optimization, and just like grabbing the data from the trading strategy you're using and applying it, seeing how it can get better, how it can get worse, what can you do to make it like more consistent and everything like that. Okay. Now, a few rules that can help you, especially if you're trading more frequently, okay? The simplest one is to never risk over 1 to 2% of your account on a single trade. So I'm not saying that you should only use like 1 to 2% of your account in a trade, but you should only risk this amount in a trade. What do I mean? Well, if you hit your stop loss level, then you're only losing 1 to 2%. Okay, so for example, if your stop loss is 20%, right? Then you can use like up to 10% of your account for that position. Okay, because if you lose, then you're only losing 2% of your account. Okay. So there's also a good rule that is very useful, especially on the beginning, is to set a maximum loss target for weeks or months, depending on how frequently are you trading. If you're trading very often, then it might be wiser to do weeks. If you're trading like maybe once every couple of days, then it might be better to do 1 month or 2 months. If you lose like more than say 5% of your account in this like 2-week or 1 month period, then you stop trading, you think about your trades, you try to learn from the mistakes, you try to see where it went wrong, and you go back like with no guilt, no trying to get it all back really quickly, because it's not going to happen. It's only going to make you lose more. Okay. Okay. Well, then you might say, I'll never get rich, right? I'm just risking 1 to 2%. I might get what 1% a month, and that's not a lot. Well, let's not rush things. Okay. If you risk a lot, you really might get rich really quick. Like, remember, the easiest way to get rich is just risk your entire account and 100x leverage and just get it right like multiple times in a row. But that's not feasible. Okay, we're not gambling here. We're trading. We're trying to let our edge or advantage over just buying and holding to amplify itself over time. So over the years, the compounding rates of that little amount you're gaining per month, it will grow bigger and bigger. Okay, if you do $100 at 2% a month, you'll have like 10x as much money in 10 years. Okay, if each year you add $100 more on your account, in 10 years, you'll have 47 times more money than you had at the start. Okay, so let that sink in. We're playing the long game here. Okay. Now, some considerations about that is that, of course, 2% a month perpetually is somewhat unreasonable to pull off consistently for that long. Okay. This served more as an example to illustrate how consistency can outperform taking them risks, right? Because if you're just taking them risks, then you will for sure get wiped out in that 10-year period. Okay. Now, one thing that's really important, and Ryan sent a video a while ago, I forgot the name of the YouTuber, but it's really interesting, that simply focusing on not losing for the first few months will already take you a long way, and you'll be better than like 90% of the traders, I think. Okay. Now, for the second part, let's talk actual risk management, right? So first things first, I want to hear how you guys manage your risks when trading or something like that. How do you guys do it? If anyone wants to go first.
Well, I do know how to set the stop losses, but I must admit that when I got in back in April and things went down, my risk management was to just not sell.
Mm-hmm. Anyone else? Oh, no one. Okay. So first things first, let's talk about the basic terms. Okay. There are a few terms that you will hear anywhere that's talking about risk management, and those 3 terms are basically risk reward, which is how many more dollars, or how many dollars actually you're making for each dollar that you're risking to lose. So for example, if in a trade, if I win the trade, then I gain $30, and if I lose the trade, then I lose $20. Then I divide those two, so 30 divided by 20, then it's 1 unit of risk per 1.5 units of reward. Okay. Position size is the easiest way to control risk, right? You just control your position size to risk how much you want to risk in that trade. And leverage is, it amplifies both the absolute risk and reward without changing your like position size. Okay. So let's understand risk reward better. Okay. The way we calculate it, as I said, is dividing the amount of money gained in case you win by the amount of money you lose in case it goes bad. Okay. So for example, if you go here on TradingView, there's this really cool tool. It's on this tab right here. And it is like long position in your TradingView. In mine is in Portuguese, but yeah. So this is for taking longs, and there's short positions for taking shorts. And you just click where you would set your entry, right? So let's say, for example, right here. And you click it, then you can make it larger if you want the trade to go on for longer. And it's not actually trading, but it gives you a lot of like cool data. Okay. So for example, let's say I'm placing my stop loss here, and I want to do this trade with 3 times risk reward ratio. So I would just drag this right here until the risk reward, like right here, it should say risk reward in your TradingView, it's at 3. If I wanted to do like 1.5, then I would drag until I see 1.5. And the same thing, if let's say the same thing for the inverse. Let's say I just have an idea for a trade and I want to see if it's worth the risk, right? I want to see if I'm gaining more in case it goes good, then I'm losing if it goes bad. Then I can just use this and drag wherever I want and see the risk reward ratio. It also says like the amount you would lose in a stop loss and the amount you would win in a take profit. Okay, so this is something that I do before I'm taking any trades, just looking at it on TradingView and looking at the risk reward ratio and stuff like that. Okay. Now, one thing that's really interesting is that to calculate the percentage of trades profitable we need to be profitable, we do like the units of risk divided by units of risk plus units of reward. So let me just grab Google Sheets right here, and I can show you how to do this really quick. So I'm gonna create a new spreadsheet. So let's say, just let it load for a bit. So let's say this will be the risk column. This will be the reward. And this will be what we call the break-even win rate. Okay. So let's say I have a risk reward ratio of 1 to 1.5. Okay. So this formula right here on Google Sheets, we type equals for placing formulas. Then I do like C3 or B3 actually, which is this cell right here, divided by, then I open the parenthesis and I do like C3, which is the cell right here, plus B3, which is the cell right here. Okay. So right here, it's in decimal, but we can do it in percentage. And you can see the risk reward, like given this risk reward, the win rate I need to be profitable is 40%. Okay. Now let's do like some other numbers, for example. Okay. Let's just copy and paste those things. So let's say 1 to 2. 1 to 2, you only need to get it right 1/3 of the time. Let's say it's actually 10 to 1. So if you lose, you lose $10. If you win, you only gain $1. Then you need over 90% win rate. Okay. And so on. You can test really a lot of numbers, but this goes to show that not just because a strategy has a higher win rate, it doesn't mean that it's better, right? If you go on YouTube searching for trading strategies, you'll often see the 98% win rate or something like this. And they're usually strategies like this, where if you lose like 10 times as much as you gain if you gain. Okay. So one good example of this as well, I can have like the most precise strategy on Bitcoin, right? It's really easy. Well, the criteria are I buy at random times, I set the trade take profit to 1% and the stop loss to 75%. I'm going to win basically 100% of the time, right? And this does not make it a good strategy. Okay. Now, as we saw, the greater the risk reward, the smaller the break-even win rate. So if I win big every time I win, I don't have to win that much. And this is really like powerful, I think. Okay. Now, yeah, as I said, misleading win rates. We're very conditioned to think that you need to get things right all the time to be good. On tests, we are like that. Well, you only get a good grade if you get 90% of the questions right. But on trading, it's not necessarily like that. Okay. There's also variable risk to reward in trailing stops, right? So many strategies, they rely on a fixed risk to reward. So first you set your stop loss at some point that you find relevant, or using some indicator or something like that. And then you set your take profit at a multiple of that. So say 1.5 or 2, those are the most common, but of course it can be tweaked to better fit the asset sometimes, okay? And some other strategies, they might have a different scheme. So either they use a trailing stop order that we talked about in the last class, right? So this would be a trailing stop order. Or they move the stops once targets are hit. So let's say they have like three targets, and when it hits the first target, then you move the stop loss to the entry price, then it hits the second target, you move to the first, and so on. Now, moving the stop losses does not necessarily make it more profitable, and you need to back test it, okay? It will usually make it more consistent in growth. So instead of like doing zigzag on your equity curve, it will be like a little bit more stable and fluctuate less, but it does not necessarily make it more profitable. When trading like really risky strategies, this is very wise to do, I'd say. Especially maybe you've seen on the Crypto Mulch channel, I'm always telling people to trail the stop losses, because, well, I'm not making those signals, right? And you need to understand the risks and, well, manage it properly, okay? Oh, sorry. Okay, so yeah, let's talk a little bit about backtesting, okay? When we're trying a new strategy, especially the more objective ones, where they only use objective criteria and indicators, and they don't rely at all on like your interpretation of the data, they are very good, I think, to backtest, because it's easy and you don't have to think much, okay? And by backtesting, you see how it behaves in the asset you're trading. If it wins a lot, if maybe you can see like trailing the stop to break even would be good in this strategy because it would prevent big losses or stuff like that. Now, small sample sizes on backtesting, they can give you a wrong win rate, okay? And also fitting the strategy very specifically to a single period of time can lead it to, so the strategy doesn't work on other sets of data, okay? So there are like two main ways of backtesting, I think. The first one is manually. You just go on TradingView, you use like the long and short position tools, and you just go and like take notes on paper, and then you might go on Excel or Google Sheets and try to fit the equity curve and look at all this stuff. But if you are good on PineScript, you can create a PineScript strategy, and TradingView can backtest it for you. So for example, let me just grab a random strategy from the TradingView library. They have some like default TradingView strategies. So let's take this, for example, the RSI strategy. And you can see, oh, it's not very good. From my testing, none of the default TradingView strategies are good, but it will like do all of the backtesting for you, and it will tell you a lot of data on your strategy. It will tell you like net profit, net loss, and the Sharpe ratio and Sortino ratio, and biggest losing streaks and biggest losing trade and stuff like that, okay? These are the two main ways you would do that, right? Now, if you're using a variable risk to reward ratio, a good way to approximate it, so just so you have an idea, is use the average gain in the strategy and divide it by the average loss. Okay. Okay. So now for the last part of today's class, let's talk a little bit about the three main different trading styles. You may have seen this in other places, but I think it's good to talk about nonetheless. So the first one is investing, right? This is not actually trading, but I wanted to put it here just to reiterate the differences between investing and trading. So if you're an investor, then you're not at all concerned with the price fluctuations or your entry price. You just buy an asset with the idea that it will appreciate in value given enough time. So fundamental analysis is like 99% of what you're doing when you're investing, okay? Now, the next style of trading is position trading. So as a position trader, your main concern is to serve a major long-term trend. Okay, you're trying to get an asset that's really undervalued compared to its like true trend value over time, and just surf that wave to the end. So you're not as concerned with current pricing fluctuations or more frequent traders, but you're still trying to get like undervalued points and selling on the overvalued points. So you have like few trades a year, you don't use leverage at all. Your position size might be greater since you're taking so few trades, and you're mostly looking at weekly and monthly timeframes. So most of the time, you'll also not use a stop loss. You might trail it to some moving average, but when you're position trading, it's not absolutely like necessary. So a good strategy, for example, for position trading, and again, this is not financial advice or anything, is to use the rainbow chart. So the rainbow chart is basically a log regression of Bitcoin, and we talked about those in previous classes. And you can see it like very accurately predicts like points of very, very undervalued Bitcoin. Okay, so here, for example, when it was basically a fire sale, that is the blue line. So yeah, this is the bottom. This right here is the bottom again, and the red lines predict the top. What's the downside of that? Well, you're maybe taking one trade every couple of years, one trade a year, something like that. Okay, so you will not be trading as much, and you have to get good timing. Okay, so next style is swing trading. So being a swing trader, your main objective is to catch a major swing in a trade. Okay, so for example, while a position trader would be like trying to catch this whole wave right here, for example, a swing trader, they might like try to predict where the momentum will change. So maybe like right here, you see, well, this is a pullback, then I'm gonna swing just to here. Then this is a pullback again, then I might kind of swing just with till here. Okay, so you're trying to time the changes in momentum of the trade, the surfs. Okay, the kind of waves. Okay, so you're mostly looking at the higher time frames on TradingView. So like 4 hour, 1 day, those time frames, they're not as low as compared to the other trading styles, but yeah, you're looking a little bit faster than the position traders. Okay, now day trading, this is kind of the most popular trading style nowadays. Everyone wants to be a day trader because you think you earn a lot of money, and your objective as a day trader is to make some money on the intraday ranges. Okay, so maybe you're buying at daily lows and selling near the daily highs, for example. Your position size is considerably smaller than swing trading because you're trading way more often, right? And you use like higher leverage. And yeah, I forgot to mention, on swing trading, you're using like little, maybe sometimes you might use like very low leverage, maybe 2x at most. But stop losses and risk to reward are really important. You want to protect your capital, okay? Because you're trading way more often than position trading, for example. Now, day trading, you take a lot more trades, and risk to reward, if you don't manage your risk, you will lose pretty quick, right? And you're mostly looking at lower time frames. So say 30 minutes and or to up to 4 hours if you want to confirm a bigger trend. Now, a day trader, they are usually trading with the trend. They're not trading against the trend. So for example, right here. Let me see. Let me take like a coin that I haven't looked in a while. So AVAX, for example, they're trading this big momentum wave right here. So they're trading this trend, right? So it's going up. They're only gonna take longs. So for example, they would go to, let's say, the 1 hour time frame and try to look for some ranged lows. So for example, you could say, well, this has bounced from support, so I'm taking a position right here. And this would be like day trading. So this would take approximately 3 days, which is not the lowest time period of a day trade. Some people say that day traders must close their positions by the end of the day, but well, if you're like positioned well, that may not be the case. Okay, and if you're like taking trades in these lower time frames, then I would still consider this day trading. Okay, so the final trading style is scalp trading, and I mean, I've tried to do it. It's not good. Okay, it's not good for your mind, I think. But if you can make a profit, then you can make a profit. But I'm not doing it. Okay, so as a scalper, you're mostly looking to profit from volatility spikes in momentaneous supply demand inefficiencies. So for example, you're using very, very low time frame. So here is the 5 minute, for example, and let's say right here it goes up by a lot very quickly. Then you enter a short right here and close it real quick. And this is, for example, like let's say a 1% move, but if you're using like 20x leverage, then you just made 20%. So these are the kinds of moves that a scalper is trying to profit from. Okay, you'll long the minute you see a breakout, you're short on a high liquidation top, stuff like that, and you're taking like multiple trades a day with very, very small position sizes. In scalp trading, risk management is like more important than any other style of trading, just because you're trading so much, right? And you'll use even higher leverage. On day trading, you're using like maybe 3-5 times leverage. On scalp trading, maybe you're using 5 to 10 times, depending on the asset, depending on what you're trading, right? And I'm talking about crypto. If you're trading Forex, where it moves like maybe 0.5% a day, then obviously you're using higher leverage, but I'm talking about crypto right here. And you're looking at the 5 minutes to 1 hour time frames, okay? So yeah, the problem with these last two, and this is I thought it was like kind of interesting artwork, just showing someone stressed. And these two trading styles, they can be very, very stressful. Okay, since you're taking so much more trades, any issues with your strategy, your mentality, or etc., it will be like multiplied by a lot. Okay, your time window to make decisions will be smaller, and well, it's just not that easy to make good decisions if you have maybe 10 minutes to think. Okay, and it demands a lot more time to be looking at charts. And well, not only this is stressful, but it can drain out your life. Okay, that is my opinion. That is what I suffered from in the past, and I say this like from a place of personal experience. Okay, so yeah,
God forbid your internet go out.
oh yeah, yeah, especially if you're one of the ones that are very disciplined and you do the stop loss manually, right? And your internet goes out and boom, you just lost a lot of money. Okay, so this was most of the content. If you guys have any questions, anything like that, any suggestions, anything you want me to look at, maybe questions from past classes, stuff like that.
I'm guessing you're probably going to get to this in your next class, but I'm a little unclear about what actual strategies are, you know?
Okay, so strategies, they are like the criteria you have for entering a trade and exiting a trade. So if you're trading like a very, very objective strategy, let's say I'm trading this strategy, I just invented it. It would be like when this indicator here, it flips color, right? And for a very objective strategy, what you might do is use, let me see, ATR band. No, I think it has another name. Okay, so ATR stop. So ATR is an indicator that I did not talk about because the formula is a bit annoying and complicated, but it's basically trying to measure how much the price can go up or go down given like its fluctuation in the past. Okay, so let me just make it lines right here. And this would be a very, very objective strategy. So let's say my strategy right here would be when this like pink and purple moving average flips color, and my stop loss will be at the ATR right here, right? And okay, so I would enter at this candle close right here, and with the stop loss right here. And then I would say, let's say my risk to reward is 1.5. So yeah, I would take profit right here. So this is a very objective strategy. And what the strategy is the criteria you have for entering a trade and exiting a trade, or replacing your targets and your stop losses, okay? Jesse's going, bye-bye, Jesse. Any other questions?
Yeah, wouldn't you be doing that at the end of the chart where you don't know what's happening
Yeah,
next?
of course. But right here you can see there's
Yeah.
no signals because it's not flipping colors or stuff like that.
Mhm.
And yeah, obviously this is the 5-minute time frame, and I wouldn't trust it too much, right?
Mhm.
Yeah, if you want to search for strategies, there are a lot of strategies on YouTube. You can search for them, but first, be sure to backtest them on the asset you're planning to trade with it. Second, try to get the ideas from the strategies. Try to think, well, what's this indicator doing in this strategy, for example? So a lot of strategies, they will use a moving average as a trend filter. And we talked a little bit about this on the indicator series, right? So when it is above the moving average, then I'm only taking longs. When it is below the moving average, then I'm only taking shorts and stuff like that. Try to find what people are using for each type of criteria, for entry signals, for trend filters, for placing their stop losses, and then maybe try to elaborate your own strategy. Okay, yeah, this is the core like principles of building your own strategy with the indicators you know and you're comfortable with. Any other questions, Scotty?
Hey, I got in late. I was struggling with my other browser, so I flipped to the different browser, and I finally got in. But I did not tune in as much, so I'm going to go back and watch the all your lessons and catch up to where you're at. And there's a lot of functionality in the chart view that I did not know was there, and where I knew it was there, but I've never really used this particular tool. I used to use TradeStation a long time ago, and I was familiar with that environment, but that's been like 15 years. So I just now really getting back into trading and fairly new to cryptocurrency. So I'll have a lot of questions later.
Yeah. Also, if you're watching this recording, you can like just shoot me questions in Discord on PM if you don't want people to see it. But I encourage like very strongly to ask publicly because other people might have the same questions. Okay. So if no one else has any other questions, do you guys have any?
One more.
Yeah.
And this kind of relates to the last classes where we were talking about indicators. Still trying to wrap my head about that. We talked about volume and how, we know what the volume is. We just don't know the difference between buy or sell. I'm wondering, like, what data is actually in there? We've got volume and we've got the price moves. Is all the indicators, is it all built off of just that?
Yeah, I think on TradingView, you can actually code your indicator to pull data from external sources, but it's very slow, I believe. Like, for example, there's an indicator for Bitcoin. Let me just get the Bitcoin chart right here. That's called the hash ribbons. And it's measuring the hash rate of Bitcoin, which is obviously not on the chart. And it's giving signals based on that. Okay. But like the regular indicators, the RSI, money flow, all of the market cipher indicators, it's all based on just price and the raw volume. So no volume delta or stuff like that.
Gotcha. So that's why it works well for stock market and Forex and anything, because that's all basic information.
Yeah. Yeah.
Cool.
Cool. Okay. So I'm going to stop recording now, and I think we can end this class.